Hey. Welcome to my live. Let me I can send out a share. Welcome to my live doing Stock Market Mondays. Godric. Okay. Welcome. Stock Market Monday night, Godric. Your stock market mentor. We're going to cover, I want to cover 3 stocks tonight that I like, and you can tell me what you think. First of all, the Dow Jones, 33,604, up 197. The date, October 9th, 2023, Monday night. The Nasdaq, or the S&P rather, the S&P 4,335, up 27. And I want to cover 3 stocks today. And then also, if you guys want to send me a message, I will answer the questions best I can about stock market, about how to retire into the stock market, about trading, about positions. I want to also, I can evaluate your stock. If you have one, give me the symbol. Or if you want me to look it up, I'll look it up for you. You guys are thinking about investing or thinking about the stock market, I can show you how to get in, do some trades, get out, investing, trading, positions, portfolios. I want to come on every Monday night for you guys. Godric here, your stock market mentor. Welcome. Send likes, man. Send shares. Get some people in here. I'm going to go for about an hour, maybe an hour and 20 if you guys want me to go longer. It's at 9:30 Pacific Standard Time. That's 12:31 midnight East Coast. Sorry if that's too late for you, if that's late. I'm a night owl. What can I do? What do I do with myself so late? I guess you heard Schwab is taking over TD Ameritrade. So the accounts are going to be switched over. Probably nothing to do, but I'll keep you posted. The first stock I wanted to talk about is Netflix. You guys who know me, who have seen my classes, have done some of my trainings, know that Netflix is my favorite stock. Has been for a while. Different reasons, but it's one of the American success stories. And they're stationed here in California. So Netflix is $3.85 and 95 cents, up $4.44 today. I like the healthy share prices. If I can get like $100, $200 share prices, I'm happy, because a high share price is better because it's showing that the stock has proven itself by going up and up. And that's better than, let's say, a $5 share price or a $10 share price, because like, where did that stock go from what to what? Like, if you look at the 10-year chart, on Netflix, you're talking about going from like $10 to like $385 in this case. So that's like 38-fold. For example, you can just do the math on that. Like, if you want to look at a stock for investment purposes, always check the 10-year chart, because that shows performance or the lack thereof. If the stock's like going down, for example, then that's bad. Like, if a stock goes down over 10 years, that's probably like a big red flag. Like, you want a stock that not only has gone up over 10 years, but has exponentially doubled or tripled or quadrupled times 5 times 10. So Netflix is one of those success stories. And it's been going on for, I want to say, around closer to 20 years, but 10 years for certain has a 10-year chart. I probably wouldn't invest in a company that hasn't had a 10-year span, but there are exceptions. Like, there's always going to be exceptions, right? But that's one of my criteria, is to have a 10-year chart, which means what? Which means it has traded for 10 years. And then two, it's performed in 10 years. Like, it's going up, right? From the bottom left to the top right. So that makes sense. I know you guys got that. Like, you want it to go up over time. And any investment kind of needs to do that. Like, if you have a company who, let's say, are making profit, have a product or a service that's making money, that sells a service or a product, something you can buy, you can have access. That's another thing. You need to be able to buy your stock or your company. So, like, for example, Netflix, you can get the monthly stream service, right? Like, it's $20 for the family plan. And you use the streaming service. Basically, like, there's a big move from going from cable and television to like streaming. So Netflix is the boss. They're the number one, and that's why they're good. And then the shares, the stock shares, have gone up exponentially over the last 10 years. For example, the company has a profit. They have a service. You can use the service. So I want to see if I can. Let me see. I'm gonna have you guys pull out a journal and take some notes. I want to write some numbers down for you. Okay, write some numbers down. I'm gonna see if I can pull up some. I took some pictures for you. Here. You can't really see that, can you? I got an Netflix chart for you, but you can't see it. Let me try again. Here's some info when you pull up Netflix. Has a price, has that it's up $4. A couple things you can look at. Market cap 171 billion. 171 billion, which means it's pretty big. I mean, I like to get in companies that are about 50 billion plus, and that's good because they're kind of like, they're not too tiny, but they're not too big. they can grow. 171 billion is pretty big. I mean, it's Netflix has just recently passed Disney as the number one entertainment stock, and Disney was around. They were going neck and neck with Netflix. But Netflix beat them out recently, last year or so, and I think Disney has about 150 billion market cap. So while they're both big, Netflix is pulling ahead, and that market cap signifies the value of their shares on the market. And the bigger companies have more perceived value because there's more investors owning their stock, and the stock is at a higher price. And as you see this 10-year chart, as you see the stock go up, you also see the market cap go up. So market cap put 50 billion plus, and then put an arrow up, meaning that the market cap has to increase over time. So I want you to keep an eye on Netflix with 171. We have to keep above that number. We have to keep that number going higher. That way it's growing. And also, unlike that, it's beating like Disney, it's beating like Amazon, So you want Netflix to be number one, but also maintaining their services and their profits. Volume is related to that. I have volume 3.299802 is 3.2 million. The reason why you want to look at volume on the stock is because, let's say this right, the higher volume, like if it's more than like 2 million a day, average, the more investors are in that stock, buying it, trading it, owning the shares. And then if this stock dips or the market corrects, then those investors are going to be able to come in and buy more shares lower, effectively supporting the stock and bringing it back up. And that's going to save your ass when you're an investor in that stock. So these big companies with a lot of volume, they're stable because there's so many buyers that are just waiting to get a deal on the stock. So heavy volume, 2 million plus. That's a criteria. So we got the volume, we got the market cap, and we got the share price. Share price is high. Share price 100 plus. Volume 50 billion plus. Market cap 50 billion plus. Volume 3.2 million plus. Guys, give me some likes. Send some likes. Send some shares. Let's get some people in here. I'm looking for any questions. Everyone has any questions? Just ask me some questions here. If you want to put your stock up here, I'll look it up for you, or I'll try. Okay, so that's three criteria: the share price, the market cap, the and the volume, right there. One thing I wanted to look at was what else do you have on here? Is the cover cost. Like with Netflix, obviously it's $3.85 a share. So on the cover call, you want to buy 100 shares. So that's going to be 38,595 in this case. And also, since we're here, let me do the other three criteria. PE. I'm pulling it up on my computer. I can't show it to you in a second, but the PE on Netflix is 44.4. PE 44.4. And basically, I just use PE as a guide. It shows profits. Like if it's positive, it's a positive number. 10, 20, 30, 40. That's a positive PE. It's showing profits. It's good. If you have a dash or a negative, that's losing money, losing profits. So you don't want that. So on the fourth criteria, PE 44.4, check. All right. The fifth thing is stock splits. Stock splits. Now, why are stock splits important? So, if you look at like Coca-Cola, Walmart, in this case Netflix, if you look at Apple, Microsoft, all these companies have had numerous stock splits. And this is one of the criteria, I think, to get what I call exponential growth. Because what happened is, like for example, like Netflix had a 7-for-1 split, so it was at $700, split to $100, right? Back like in let's say 2014, and so if the price is $700, a 7-for-1 stock split, what happened is the price will jump down to $100, but you'll have 7 shares for every 1 share. So let's say you had 100 shares at $700. With the stock split happening for 7-for-1, you'll have 700 shares for $100, and that way you get the same value. But here's the magic, okay? If the shares split from 700 to 100, which is 7-for-1, what will happen is that $100 price is perceived to be a good deal and perceived to be cheap. And what will happen is the investors will come in and buy more shares at a lower price. And considering that they have more shares, they'll buy more shares at a cheaper price. And what happens is they'll move that price. When you buy, it brings the stock up. So as the shares are normally at 700, they go down to 100. It's perceived to be a cheaper price. Those shares are starting being bought up over time by investors. Price starts creeping up back to, in this case, to 700. And that way, in this case, you made 7 times your money, because what? Stock cost 700, it split 7-for-1 to 100. You got 7 times the shares. So same value at this point, but then when the stock starts being bought up because it's perceived to be a good price, now your shares go back up to 700, and you've won. Now you have 700 price again, but you have 7 times the shares. This is like a classic stock split for Netflix and other stocks. So you effectively multiplied your investment times 7. And this just happened with Netflix in, let's say, the last 3 or 4 years. And it's happened to Coca-Cola, to Microsoft, to Walmart, to all these big companies, Amazon. So stock splits, major criteria for stock selection. You can go to stocksplithistory.com. Write this down, stocksplithistory.com. And just put in your stock, Netflix or Starbucks or Coca-Cola. You'll see all the stock splits they've had. So buy a stock that's had stock splits. That's what I'm trying to say. I know that sounds kind of crazy, because like, why? Who cares if you're getting the same value? But no, because it climbs up afterwards. Like another thing you probably don't know, most companies will never have a stock split. Never. Only what I noticed, only the top companies, the very best cream of the crop, will have forward stock splits, 2-for-1, 4-for-1. Tesla had a 5-for-1, and I had a 4-for-1. Apple had a 4-for-1. Only the best companies have stock splits, and then what happens is companies, the shares start climbing back up. So stock splits is the 5th criteria. And then the 6th criteria is the covered call. Covered, like cover the blanket, covered call. And with that one, you have to pull up the option chain. I'm going to do that. Let me see if I can do that for you here. Thanks for the follow. Okay, here's the option chain for Netflix. I don't have, unfortunately, I don't have the whole chain, but I have November. So it's October now. So I pull up November. So here in the middle is the strikes, 375, 380, 385. When your stock, the share price is 385, and I'm showing you 385, it shows 23.20 by 23.45. So left side bid, right side ask on the calls. So let's do the math on this. I'm going to show you how much it pays. So you get a calculator, do 23.20, so that's the bid. You divide that by the share price. In this case, 385.95 equals 6.06%. 23.20, which is the bid on the strike 385, which is matching the share price. You see that? How the strike matches the share price? 23.20, and then divide that by the share price of 385.95 equals 6.011%. Actually, it's 0.06, but you have to move the decimal over two places for the percentage. So 6.0% return. What that means is you agree to sell the cover call for the next month, and you're going to get a premium for that. Now, I don't prefer to sell the 385. What I like to do is go down, like you can go down here. You can sell that 400. So put here 385. Let's do the 400. And that says, what does it say? It says 1620 by 1655. What's happening here? When you write the cover call, here's my analogy. As apartment owners own the apartment and rent out the rooms, shareholders own the shares of the stock, blocks of 100 shares, and rent out those shares. We collect an option on those shares. In this case, I'm going to show you something. 400 for Netflix. This is November. It's October. Right, November. That's 1 month out, and we're going to get 1620. Okay. So the difference is we're agreeing to sell it for $400 a share. That's if you write the 400 strike. You see how that looks. And the 400 strike gives us, let's do the math, 1620 divided by 385 and 95. The cents doesn't matter too much, but I'm going to put in the cents just so we can do it right. 4.19%. 4.19. Let's just say 4.2. Close enough. 4.2% return. So to get a 4% return, we're going to buy 100 shares of Netflix, 38.5K investment. Okay. That's if you don't use margin. Let's just say you don't use margin. And you're going to write the call for the following month. If it's October, you write November. If it's November, you write December. The correct option chain is always the third Friday. So it's the monthly, not the weekly. Write it down, monthly. And in this case, 4.2% return. And what happens? We're agreeing to sell the stock if it goes to 400 or higher. So if the stock goes to 400 or higher, it'll sell for 400. We'll get our premium of 4%. In this case, $16.20 per share, which is $1,620. Okay. Now, what can you do with that? That can pay your rent. That can pay part of your mortgage. That can pay your car note. That can buy food. So I'm showing you guys some numbers so you can get your bills paid with these cover calls, with these investments. If you can have at least 100 shares, look about writing the cover call. Now, not all stocks have good cover calls, but let's say most stocks have option chain, and most stocks have the volume. No, let me take that back. The good stocks have the volume, have the good option chain, which gets you, let's just say, 3 to 5% per month return. And I like to say, do 10 cover calls a year. And if you're between, let's say you're Netflix, 4.2% times 10 cover calls, that's 42% return a year. Okay, so you're making $16.20 a month on 100 shares on your investment for $38,000. But a year, that's 16. I'm going to multiply it by 10 because I want you to be able to screw up twice or waste the time. Skip 2 months, take 2 months off. That's $16,200 a year. And even if you skip 2 months, you're still going to be 16,200 divided by 12. You're at $13.50 a month, right? So think about this. If you are going to be a cover call writer, one thing that I always look at is how much do you need to live off of your account, to live off your cover calls, to pay your bills nicely, and have some money left over. So if your bills monthly are like, let's say, I don't know, $6,000, okay, or let's say $7,000 because you want to have some to go extra, right? Then all you need to do is work on your positions that are going to bring you $7,000 a month on, let's say, these cover calls. Now, if it was Netflix, for example, we know that we can get $1,620 a month on Netflix for $38,500, $595. So, at 4.2%, how are we going to get to 7,000? So what we can do is just the math. Okay, so we can do 100 shares gives us 1620. 200 shares gives us 3240. Okay, so 3240 a month on 200 shares of Netflix, and that's 38,595 times 2. We're at 77,190. Okay. Now, getting a little bigger account, build up over time, save money, right? Like monthly, put money in there, $100, $500, whatever you can do. Hopefully you're making good trades, you're doing cover calls, you're getting dividends, you're saving over time, you're building your account. Three cover calls on Netflix. Gonna get us 4,860, 4,860, and 77,190 plus 38,595 equals 115 grand, 115,785. So we're almost at 5,000. Your investment is 115,785. You don't have 100K. Sell all this shit in your garage. Like, save money, sacrifice. Save money like it's a religion. Don't eat out so much. Don't waste money eating out. Like, get a pack of meat, a pasta sauce. Get some lettuce. You can cook a nice meal at home for your whole family for like $15. I'm trying to save you $100 on your family dinner for Friday. Put that money in your stock market account. Your family will appreciate it later on when you get older, when you've saved money over time, when you've applied your discipline. They will love you. Like, if you don't do that, I don't know what you're going to do. I mean, I'm trying to teach you one way to retire into the stock market. Let's do one more. 1, 2, 3, 400 shares on Netflix. Get your 4 cover calls. There's no limit, man. There's like 1,000 volume on some of these positions. So like you're like 4 contracts is nothing. It's like not even a drop in the bucket. You're just going like with the flow of, it's like an ocean of money happening. Just get your piece of the pie, okay? So 4 cover calls on Netflix, 6,480. Let's do 5 cover calls on Netflix. 5 times 16, 20. Remember, you're going to sell a stock at 400, so you can actually make more money if the stock goes up. Like between 385 and 400, that's another 15 points. So while you can buy the stock here at 385, you're going to sell at 400. If the stock doesn't just stays the same price, you're going to get your premium, walk away, no problem. If the stock shoots up past 400, you're going to get 15 points more. So you're getting like 30 points, 32 points in this case, because your stock will sell at 400 and you're going to get your premium. So it's a win-win, basically. The only thing you're giving up is if the stock shoots way up, like stock shoots to like 420, 440, 480, 500. So you won't get that money because you agreed to do the cover call, which limits you, in this case, 400. So you don't get money past 400, okay? But here's the thing. Here's the theory with the cover calls. You're getting consistent profits monthly. You're getting consistent premium monthly. And while still maintaining some kind of play in the stock, like you get some kind of upside in the stock, which like if you want to write the 385, which I showed you, is 2,300, fine. But what I've noticed is that these stocks that are going up over time, that have a 10-year chart, that are performing, the best balance with the cover call premium and the strike is to have your premium equal to the distance between the share price and the strike that you're going to write the cover call. In which case, the stock is 385. Follow me, write this down. This is called the sweet spot. SWEET spot, SPOT. The stock is 385. You're getting about 15 premium, 16 premium, okay, for the 400. So if you write to 400, that gives you 15 points of share growth, 16 points of premium. You see how it's almost identical? So sweet spot. Share growth, which is the distance between the share price and the strike price you're going to write it at, is equal to premium. Equal to premium. See, if you can go ahead and write the 405, and you're going to get 14 points. So in which case, you're going to get 20 points of share growth, potential, not for sure, but you could get that much. And then 14 points of premium. But if you do the 400, you're going to get 20 premium in hand, in your pocket, in your account. And you're going to plan on gaining as much as 15 points, actually 14 points, because 385, 95, it's like 386. 14 points of share growth, so it's about $3,000. So you could make more than the 1,600. But let's do the 5. Let's do the 5 cover calls, 5 contracts. 8,100. At 8,100, you're doing all right. I'm kind of gonna respect that, because that's kind of like, I don't know, that puts you in like 100K status. So 8,100 income a month, and that's going to be 500 shares of Netflix. So 500 times 385.95 equals 192,975. 193K. Okay, so like maybe not today, but like if you have a long-term goal for anything that's worth a shit, it takes time, effort, it takes patience. Build it up over time. Like 200K is not even a lot of money. I mean, you can have that like in your retirement account. You can have that like at your job IRA after like 10 or 20 years. So most people will have that like in their house, in their property, like inherited, like refi. Like now, one question, like should you put it all in Netflix? Well, you could do that, right? You could diversify. For example, like I was showing you Tesla yesterday. Last week. I was showing you Palo Alto. Write this down. Tesla, TSLA. Palo Alto, PANW. Apple, AAPL. So, I mean, show you these other stocks. So you can actually diversify. You can have like 3, 4 positions, 5 positions. It kind of helps balance the account. But you can also put it all in one stock. I mean, it's more risky, but like the reward is there, right? More risk, more reward. Like you're not investing like in a fly-by-night company. You know, this is Netflix. They beat Disney. They beat Amazon Prime Stream. They're the boss of stream. Okay, you get the idea. I want to monologue that, but let's just say 200K at 4% equals 8K a month. You get that, right? So, you could divide that, like I said, in Tesla, in Palo Alto, in Apple, and just break it up. Do one cover call on each. But the whole point of it is you're getting cover call income. You're being consistent. You're doing, hopefully one trade a month, but you can do 10 a year. The length of your cover calls, put 3 to 7 weeks. 3 to 7 weeks is like a magic number for me. It's just easy, simple. You pay your monthly bills. You're making a plan to retire into the stock market. That's what I teach. So follow me, send some shares, give me some likes, send some comments, message me. I can go over the details with you, no issues. Like, this is what I do. I'm your stock market mentor guy. Okay. Should we jump to, if you have any questions? See. Thank you guys for watching. Appreciate you. Give me some likes. Send some shares. I got some hearts. Cool. Hearts are good. So let's look at, can we look at Skechers? Skechers is a shoe company. They have, a product, right? I mean, at least you can buy it in USA. I don't know what country you're in, but I think most people can buy Skechers at their local Skechers. $47.90. Let me see if I can get the picture for you. Get my picture of Skechers for you. There you go. Okay. How do you make it so small? I mean, forgot how to do that. All right. SKX, $47.90. Okay, a share. So 100 shares, you're going to be at 4.79K, 4,700. So much smaller company than Netflix, easier to do, right? Market cap, but look at the market cap, 7.413 billion. Kind of small. I'm not gonna lie. Like, you're kind of taking a chance because, like, a small company like Skechers. Now I know that they've been around the block. They kind of know how to perform. They've been on the stock market for 10 years, so they have all the criteria. Like, they have they have the 10 years. They don't have the market cap. I'm gonna put an X. Market cap, put an X. They don't have the share price. $50. Not really impressive. I mean, if you look at the 10-year chart, I mean, it's kind of went from like 30 to 50 maybe in 10 years. So it hasn't really. So 10-year. Let's put an X. Volume. Oh, look. Wow. 1.28 million. 1.28 million. They have some volume there. It's not tiny volume. I mean, there's some traders, investors in there. So what's happening? You're exchanging price, right, for stability. Like, it's not Netflix. Like Skechers is like small time. Like, if you look at Netflix at 171 billion, let's do division. 171 billion. Let me just do this. 171, make it easy for you. Divided by 7.1, 7.4. 7.4. 23 times. So Netflix is 23 times bigger than Skechers. Okay, so like just think of like size for a second. Like it's like a midget compared to Netflix. All right, but let's look at this. Let's look at the cover call. I know I took a picture of it. Let me see if I can get it for you. Let's just jump to the cover call. I don't think Skechers has had any stock splits. So again, you're exchanging like price for excellence. Here we go. Okay, here's the option change for next month. Hello, bottles of Halcyon. Hello, welcome. Give me some likes, send some shares, appreciate you. All right, so we're talking about Skechers. So here is the option chain, and I'm going to show you that if the stock is 47.90, we can agree to sell the 50 strike, and here it bid 190 by $2. So write this down: 190. That's $190 income per cover call per contract of Skechers. So if you have $4,790 investment, you're going to get $190. Have you looked at Aehr? I've been holding it $13. Thanks for the question. Let me just see if I can pull your stock up. AEHR. Don't get mad if I tell you it's trash. I'm just going to give it a little bit of a Aehr Test Systems. It's not coming up on my... they're doing maintenance. They're doing maintenance. Can you do that? AEHR. I might need to take a rain check. They're doing an update doing an update on the website. Let me get a rain check on that, my friend. I'll give me till next Monday, and I'll do 6 criteria for you on your stock. Okay. But back to Skechers. Been dipping lately. Not sure why they had good earnings. Okay, so when earnings happens, keep in mind that like all the magic is out. It's already out. Like, so there's anticipation before the earnings, so it can go up. But after the earnings, it's kind of like it tends to cool off because we know what the earnings are. Even if they're good, we know what they are. So it's like not going to be like anything happening. So they kind of cools off. That's probably why it goes down after the earnings, even if they're good. But I'm going to check for you by next Monday the cover calls, the PE, for example. I'm going to look at the volume. I like to look at volume. I like to have 2 million a day. I like to have 50 billion market cap. I know probably your stock doesn't have that. Don't worry. But it's like, it shows like a stability. It shows like a size that won't get like is big enough to survive like an economic correction. Okay, you see. All right. So back on Skechers. If you're making 190, right, for selling a 50 cover call, so let's do the math on that. Get your journal out. Put 190 divided by the share price of 47.90. Oops. 47.90 equals 3.96% return. Great return, 3.96. Now we know that we're looking to get 3 to 5% per month. Okay, Skechers gives us 3.96. Not as much as Netflix. Netflix gives us 4.2. But here's the thing: Skechers is no Netflix. All right, let's just throw it out there. It's a smaller company. They pay less on the cover call, but still good. 3.96. So like, if you had 10 contracts, right? 10 contracts, 1,000 shares of Skechers. The 190 for one cover call becomes $1,900. Okay, income per month. Agreeing to sell the shares if they break 50. Okay, you'll get more. You get more share growth. You get more income. You get more profits when the stock goes from 47.90 to 50 and beyond. But on the cover call, our profits stop at 50. I want to be very clear. That's what we give up. We give the upside. We give away the upside to get cover call return. We get maximum return of the strike we write. In this case, right here in the middle, 50 pays us 190 by $2. Make sense? So investment of $47,900 gives us $1,900 a month. That's 10 contracts of Skechers. We're in the ballpark. I mean, it's not in Netflix, but it's cheaper than Netflix. I mean, who can't get together 5K, right? Or even 200 shares is like not even 10K. Okay, let's do one more, and then we'll call it a night. I do want to see if I can answer any of your other questions. I don't know what the hell's happening with this. The updating. Let me try again. Aehr Test Systems. Oh, here we go. Are you there? Still there, bro? It came up. $37.16. Down 148. Not good, but volume 1.5 million for a 10-day. Not bad volume. I'm gonna give it the volume. I'm gonna push it through because why? Because it's almost 2 million. Why not? Let's give it the volume check. So I can't give it the share price check because it's so low. But $37 is better than $5. I mean, you know that you're not doing penny stocks. Market cap 1.1 billion. Ooh, bro. Your company has the value of a property in Bel Air. 1 billion. They probably have like 10 employees. I'm just gonna guess. Like, can you buy the product? Like I hear like these like stock market advice. If it's stock market advice, like who gave you this company? Like, are they? How long? Let me look at the 10-year chart. I'm not gonna talk it down until I see a 10-year chart. Well, hey, they've been around for 10 years. It has gone up over 10 years. It started going up in 2021. So they do have a 10-year chart. I'm going to get the 10-year chart check. Market cap, no. Share price, no. Volume, yes. 10-year chart, yes. PE, my friend. Does it have PE? Everybody, AEHR. Does it have a PE? Does it make profit? Yes. PE 61. So they got a PE, they got volume, they got 10-year chart. They don't have share price. They don't have market cap. Let's look at the cover calls, shall we? I'm going to tell you they have no stock splits. I'll tell you that right now. These are the cover calls. Option chain. Let's do all. U-chain. They do have November calls. I know they have volume, so they have 36. Okay, so I would write the 40. Oh, look. Whoa, dude. They have cover calls. 40. Cover call. You can buy the shares here at $37. Write the 40, 37.15. Write the 40 cover call for 250 by 265. Whoa, bro. 250 by 265. So that's $250 per 100 shares. Your investment, if you buy 100 shares, that's $3,715. So if you write the cover call for the 40, you have some share growth potential, but more importantly, you got 250 premium, $250, which is more than Skechers. And at 10 contracts, 1,000 shares, you can write 10 cover calls, 10 CC cover calls. So you're gonna get $2,500, bro. A month. It's about a month. It's like right now we're on. If it's the 9th, so if you write November, that's November 17th. So it's like 5 weeks, so a little more than a month. So let's say you do it 10 times a year, okay? You're getting at 1,000 shares, you have 37,150, and you get 2,500 income, and then 25,000 a year. Now let's do the math on that. The math is good because it pays more than Skechers. So we're going to go 2.5. Follow me. 2.5. Write this down in your journal. Divided by the share price of 37.15. 6.7%, bro. Whoa. Nice. 6.729% for Aehr Test Systems. So 67% per year. Awesome. So we got the cover call. We got the volume. We got the PE. We got the 10-year chart. We don't have the market cap. We don't have the share price. But we have the cover call. Nice. So I like it. Now, it didn't really take root until 2021. So even though it's been traded for 10 years, it didn't really get active until about 3 years ago. So I would keep that in mind. I would keep it in mind, like, can you buy the product? What do they do? Should I look? Should I look at the fundamentals? Aehr Test Systems is provider of test solutions for testing, burning in, and stabilizing semiconductor devices of wafer level, singulated die, and package part form. The company's products include the Fox P family of test and burn in systems and Fox wafer pack aligner. Dude, I don't know what that is. It's a semiconductor. Okay, so computers. All right. So probably good. I'll give it my stamp of approval. Sound good? They're moving into memory chip testing soon, which should rocket to triple digits. Well, hey, this is kind of like Microsoft started somewhere, Netflix started somewhere, and they're gonna do that, and if that works, yeah, the stock will probably shoot up. You probably don't want to do the cover call. You probably want to buy a call, spend $250 and buy a call, right? But I'm impressed because the cover call pays 6.7%, and you got 4 out of 6 check marks. You got 4 out of 6 criteria. So yes, so good. Now let me get to. Yeah, it could be monstrous. It could be. Let me jump to my Roku. Maybe we can close up for the night. Appreciate you. Send me some likes. Give me some likes. Get some people in here before we close. Give me some follows. Give me some shares. All right. Appreciate you guys. If you want to give me another stock, I'll look at it. But right now I'm going to jump on Roku. You know Roku, the streaming service. They sell the little Roku box, like a Fire Stick. But Roku, I think, is cheaper. One, and it has like channel. It has channels on there. Like you don't even have to pay monthly. Just buy the Roku, like $30, or they have advanced ones for like $75, $100 for like all the bells and whistles. But the basic one's $30. You can buy the product for $30, and you're gonna get like streaming services. Like it won't give you like Netflix, but it give you access to Netflix. It's access to Hulu, to Amazon Prime. But like they have like a Roku channel, which is basically free. You just have to watch their commercials, and they have like movies and stuff, different channels on there. Okay, let's see if I can pull up. I took a picture for you, so I can pull up. Okay, here, 71.72, 71.72 share price. So the share price is getting there. I want to tell you that Roku was like back in the day, before like the COVID, they were like $300 a share, like no issues. But like it sold off. We had a tech correction, and it came down like to 38. But now, it's starting to creep back up. So here's where I think, we're gonna revisit our old numbers, 100, 200, So I think that's gonna happen. So that's why I like it. But let's look at the market cap, 10 billion. Not great. No no check mark on that. But hey, it's 10 times bigger than Aehr Systems. Now, Netflix is 171 billion, so this is like 1/17. Netflix 17 times this company, so still small. So what? Has room to grow. It can grow. Volume. Oh look, 3.386 million has volume. Somebody's trading. Somebody's investing. If the stock dips, there'll be investors, traders buying that share price when it's lower. So I get the volume. I don't get share price. I don't get market cap. I'm going to show you the cover calls. I get the cover calls. That's 2. Unfortunately, right now, it doesn't show PE, but it will have PE because they're doing some work on their books. So I'm going to give it half credit for the PE. Got 2.5. It lost its PE. It had a PE, had to spend some money. It lost its PE. This is like stuff you monitor as a stock market investor. Like, are they showing a profit, right? What else? They don't have stock splits. They have the cover call. Let's just jump to the cover call. Get that pull up for you. Here we go. All right, so if the stock is 71, right to 75, we see it, for 495 by 510. That gives us 318, check my math, 318 share growth, which is good. And we're getting 495 income premium. I'm a cover call for November for the strike, 75. So 495. Do the math. Buy 100 shares, spend $7,172. And you get $495 per month. 4.95. Do the math with me. Write this in your journal. Divided by 71. 72, 6.9%. Hey. I beat your Aehr Test Systems, bro. 6.9% return on a cover call. Aehr Test Systems at 6.7. Hey, I'll take a win. I'll take a win when I can. I'll take a W. All right, so it has a cover call return. What that means is we're going to get about 69% return a year. We do 10 cover calls for Roku. Probably Roku will break 100, break 200, but it takes time. So why hope for something? I mean, when I get a monthly income for sure, then to hope that one day it shoots up. So that's the cover call in a nutshell. You're giving up the upside, and you're getting a monthly return that's, I want to say, consistent. In this case, good monthly return, 6.9%. So let's do, so we're at $495 for $7,172 income investment on Roku. Now, if we double that, we've got 200 shares of Roku, 77172 times 200, 14,400, and that's going to give us 495 times 2, $990. Can we say 1,000? Can we say $1,000 income on Roku? 14,400 gives us $1,000 income on Roku per month. Can we just add a zero, like 144,000? No. Yeah, 144,000 on Roku gives us 10 grand a month. Do you see? I'm trying to retire you, bro, into the stock market. Write this shit down in your journal. Actually, Roku is down 50% for the month. This might be a good time to buy. Yeah, I want to say something. Thank you. Thanks for bringing that up. If you're doing stocks, if you're doing cover calls, whatever, you're going to go on a roller coaster, bro. Your shit's going to go down in value. You're going to see, like, your stock go down. I'll be the first person to tell you your stock will go down. I don't care what stock you got. You can have Apple. You can have Netflix. You can have whatever. Google. But if you're doing cover calls, you just hold on to your shares. Don't sell. Write the cover call monthly. And the theory is after a year, you're going to have all that income. In this case, 10 cover calls on Roku. You're gonna get what? Your $7,000 investment on Roku is bringing in $495 a month, but it's bringing in $5,000 a year. So think about that. Like, you're getting almost all your money back, getting $5 grand in a year for a $7 grand investment. So, like, the theory, like I said, is over time you're gonna have income, beat the overall market. You're gonna beat probably the average Roku investor because you're getting monthly money on the cover call. You know, beat the market, outperform. You're gonna do good. You're gonna do well. What is a bird in hand is worth two in the bush, right? What are we saying? It's better to have some money up front in your hand than like the hopes that your stock will shoot up one day. Which, you know, your stock may shoot up one day. I don't know. Maybe if it's Aehr Test Systems. Typically, I just buy the shares. I need to learn the other stuff that you're talking about. Yeah, good cover call. Would you look at CJET? Penny stock, dude. I'm gonna just tell you, don't make me look at a penny stock. I don't like penny stocks. I want to teach my people to have like standards. $5 or lower is a penny stock. Let's not do that right now. These stocks I do, they have PE, they have profit. I guarantee if you have a penny stock, it doesn't have profit. Probably doesn't have a 10-year chart. I like to have a 10-year chart. I like to have PE. I like to have volume. I like to have market cap. And I don't mean a billion. I mean like market cap 50 billion. Like Chipotle is at 50 billion right now. Okay, back to Roku. 144K investment, bringing you in 10K on the cover call. That's 10 contracts. Wait, no, that's 20 contracts. You see, $500 per month on 100 shares of Roku. On 1,000 shares, on 2,000 shares, 10,000 a month. Check my math. I'm kind of happy with that. I want you guys to write that down in your journal. Cover call. Write those numbers down. I'm going to save this video and send it to my YouTube. My YouTube in my profile has my long videos. If they don't bore you, then check them out. I appreciate follows, subscribes, and we can get all this stuff saved for you in case you miss something. Get these golden nuggets. My YouTube is Affluence8, AFFLUENCE 8, with no space, the number 8 with no space. That'll get you my YouTube, and I'm going to download this video. And I do every Monday night, at least an hour, looking over these cover calls, looking over these stocks, giving you some criteria, answering your questions. Dr. King, your stock market mentor. Thank you guys. Until next week, bro. Have a good night.